How to make money in stocks. Opening an investment account and then purchasing stocks or stock-based funds, employing the buy and hold strategy, investing in dividend-paying firms, and exploring new industries are all ways to generate money through the stock market. 1. Create an account for your investments. You're required to have an investment account to be able to make money via the use of stocks. When you open an investing account, you deposit money into it, and then you can use that money to purchase stocks. An investment account is comparable to a bank account. Your investments will be stored in an investment account, which is not an investment in and of itself. Examples of investment accounts include a regular brokerage account, a Roth IRA, and a 401 plan. Several different types of investment accounts are available, and selecting the appropriate account for your investments might potentially save you a significant amount of money on taxes. For instance, financial planners frequently recommend that individuals begin their investment journey by opening a 401k, which is a type of investment account that is made available by companies, particularly if the employer provides a match. And then if you have any money left over, you should go on to a traditional brokerage account. 2. Rather than investing in individual stocks, choose stock investors. Rather than purchasing a large number of individual stocks, there is a method that is not only considerably simpler, but also frequently more beneficial for those who are interested in making money through the stock market. It's not necessary to have a great deal of knowledge about the individual firms to be successful with index funds, because they are composed of dozens or even hundreds of equities that are a reflection of a market index, such as the S&P 500. By investing in index funds, you can invest in a large number of stocks all at once, and you do not have to handle each stock individually. One way to reduce the amount of risk you take is to invest through funds. If you have investments in 500 different companies and one of them goes out of business, perhaps it won't have as much of an impact on you. To answer your question, it is mathematically feasible to achieve larger returns with individual stocks than with an index fund. However, to obtain those returns, you will need to put in some effort to research firms, and the likelihood that you will lose money is higher. 3. Stay invested with the buy and hold strategy. Financial gurus believe that being invested in the stock market is the most important factor in achieving success in the stock market. Remember that even if you are investing in funds, you are still investing in equities. You can most accurately forecast your overall performance based on the amount of time you have spent in the market. The approach known as buy and hold is exactly what it sounds like. You acquire stocks that you believe will do well over the long term, and then you keep those equities for several years to come. It is better than the returns you can get from a bank account or bonds to invest in the stock market, which offers an average yearly return of a cool 10%. However, the majority of investors do not achieve that 10% simply because they do not remain engaged for a sufficient amount of time. They frequently enter and exit the stock market at the most inopportune times, preventing them from reaping the benefits of annual returns. Producing a profit from stock trading does not take place overnight. Some individuals engage in day trading to make a quick profit. However, day trading is associated with increased dangers. When it comes to investing, the majority of financial gurus will advise you to only put money into investments that you won't require for at least 5 years. In this manner, you will have the opportunity to continue making money even while the market has ups and downs. When you have been investing in the market for a longer period, there is a greater possibility that your investments may increase in value. The stocks that have performed the best throughout time tend to raise their profits over time, and investors often reward these increased earnings by increasing the price of the stock. Because of the greater price, investors who own the stock will receive a return on their investment. 4. Consider investing in stocks that provide dividends. If the company distributes dividends, you will be able to receive them if you have been in the market for a longer period. If you are trading in and out of the market on a daily, weekly, or monthly basis, you can say goodbye to those dividends because it is quite likely that you will not own the stock at the important moments on the calendar to receive the payouts. There is also the possibility of investing in high dividend exchange-traded funds, which are a sort of vehicle that is comparable to an index fund. 5. Investigate the possibility of new business sectors. Certain industry stocks, such as commodity stocks, have a proven track record of success. Others, such as stocks in artificial intelligence, are currently thriving, but this could alter in the future. Even if picking individual stocks is a dangerous endeavor, it can be thrilling to investigate industries that are experiencing growth. Doing your study and researching this sector, as well as any potential investments, is the first step you should take. Investing in industry exchange-traded funds, such as artificial intelligence exchange-traded funds (ETFs), is one approach to reducing the amount of risk you take on. 3. Investing misconceptions. There is only one market in which the items are put up for sale, and everyone gets a little anxious about purchasing them. That market is the stock market. This may appear to be absurd, yet it is precisely what takes place when the market experiences a decline. It is not surprising that investors experience fear and sell their holdings in a frenzy. On the other hand, as prices go up, investors rush in with both feet. Instead of buying low and selling high, this is the ideal recipe for buying high and selling low, isn't it? Investors need to be aware of a few common misconceptions to avoid making these blunders. 1. I'll hold off on investing until the stock market is in a secure environment. After stocks have seen a downturn, when it is frightening to purchase into the market, people may sense the temptation to delay investing because they are afraid of the market. There could be a few days in a succession in which stocks have been falling, or it could be that they have been falling for a longer period. On the other hand, when investors suggest that they are waiting for it to become safe, they are waiting for prices to increase. Fear may be the driving force behind this action. Nonetheless, psychologists refer to this more particular behavior as loss aversion. To put it another way, investors would preferably prevent a loss in the near term at any cost rather than generate a gain in the longer run. Therefore, if you are experiencing agony as a result of losing money, you are likely to try everything to alleviate that misery. Instead, you sell stocks or refrain from buying them even when the prices are low. 2. When it's lower, I'll buy it back in the following week. People tend to believe this myth while they are waiting for the stock to plummet, but it is impossible to predict the direction in which stocks will move on any given day, particularly in the immediate future. Next week, there's a possibility that the stock market or market could either climb or decrease. Many seasoned investors buy stocks at a low price and then hang on to them for an extended period. The practice of dollar cost averaging is something that you could be interested in if you are experiencing the desire to wait for a better price. This is a method of investing in which you make investments at predetermined intervals over some time. This helps to distribute your purchase price over a longer period, ensuring that you do not put a significant amount of money into the market at times when the price is either extremely high or extremely cheap. 3. I had enough of this stock and I've decided to sell it. Even if some investors enjoy the excitement that comes with investing in the stock market, that is perfectly acceptable. Investing might be considered a hobby for certain individuals. And as long as your funds for retirement are already invested in less risky investments, it can be enjoyable to put some of your money into interesting stocks, cryptocurrency, or other alternative investments instead of traditional investments. On the other hand, the majority of wealth-building investments are quite dull. The most successful investors allow their equities to gradually increase in value over several years. One can get the impression that successful investors are trading every day to make significant gains. Although there are a few traders who can accomplish this, they are extremely uncommon. When it comes to investing your hard-earned money in the markets, it is natural to feel some anxiety. However, if you have a strong aversion or fear of investing, it may be beneficial to consult with a financial therapist who can assist you in identifying and overcoming any financial trauma you may be suffering. Would you like it? Please join us, and don't forget to like and subscribe our YouTube channel for more interesting and informative videos.